Hey rich girls, Kirby here, and I have a question for you today. Are you scared to move up a tax bracket? We're going to be breaking down common misconceptions about moving up a tax bracket and why you should not be scared to make more money. Let's get into it. This is Rich Girl's Guide, where we demystify the world of personal finance to help you create a financially successful and fulfilling life. I'm Kirby, a former wealth management 9-to-5er, and I'm gonna be honest here. I genuinely don't know why our public education system does not have a simple tax class in high school. For the most part, taxes aren't that complicated. We'll go over a few examples in today's episode to prove that point. And once you learn the basics, I think you'll be a lot less scared of potentially moving up a tax bracket. Now, of course, tax law can get complicated quickly, but for the majority of us in an average year, there's really not that many moving pieces. Let's start out by explaining the 7 different federal income tax brackets. We'll be using 2024 figures in today's episode. The IRS has broken up potential income spanning from 0 to an unlimited amount into 7 different income ranges. These 7 income ranges are what are known as the tax brackets. If you've ever heard someone say that they are in the blank tax bracket, they are essentially telling you the income range that they fall into. Now, the brackets are broken up in a way so that the more money you earn in a single year, the higher percentage you will pay in federal taxes on those higher dollar amounts. Now, before we get into the numbers, let's start with a common misconception. Have you ever heard someone say that because they earn $50,000, they are in the 22% tax bracket? While it is true that some of their top earnings will be taxed at that 22% rate, it does not mean that all of their income will be taxed at 22%. In fact, for a single tax filer that earns $50,000, only about 6% of their income, a little less than $3,000, will be taxed at that 22% rate. Let's explore how that works by breaking down the 7 different tax brackets. Starting at the lower end for a single tax filer, you will owe 10% on the first $11,600 you earn. If you earn more than $11,600, then you will owe 12% on the amount of income above $11,601 and below $47,150. You will still only owe 10% on the amount of money you earned in the lower bracket. By the way, if you are listening on Apple Podcasts right now and you're a bit lost with all of the numbers, I would highly suggest watching this episode on YouTube for a better visualization of what I'm explaining. I'll drop a link to the YouTube video in the description below. So this continues for the remaining 5 tax brackets, which are 22% on income between $47,151 and $100,525, 24% on income between $100,526 and $191,950, 32% on income between $191,950 and $243,725, 35% on income between $243,726 and $609,350, and finally 37% on income over $609,350. All right, I'm out of breath at this point. I feel like Dochi right now. Okay, that was a lot of numbers that I threw at you. Let's take a look at an example to help you wrap your head around those figures. Let's say you are single and have a taxable income of $58,000 a year. Using the 2024 tax figures, you will owe 10% on the first $11,600, which comes out to $1,160. You will owe 12% on the income above $11,600 and below $47,150. So we are going to subtract $11,600 from $47,150, which gives us $35,550. 12% of $35,550 equals $4,266. Now we get into our final tax bracket of 22%. We will owe 22% on the income above $47,150. So let's subtract that from our total income of $58,000. That ends up totaling $10,850. We're going to multiply that dollar amount by 22% to get $2,387. So between all three of those tax brackets, you will owe $7,807. Now, in this example, you might tell people that you are in the 22% tax bracket, but your effective tax rate, the actual amount of tax you paid compared to your taxable income, is actually 13.5%. To find your effective tax rate, all you need to do is divide the dollar amount of tax owed by your taxable income. Hopefully you are starting to see why it should not scare you to move up a tax bracket. Just because you hop up a tax bracket by making more cash does not mean you are paying more taxes on the income that you were already making. You will always pay the same amount in taxes on that lower amount. You are just paying more taxes on the extra money you are making on top of it. So don't let taxes scare you for going for that promotion, to get that overtime, to start that extra side hustle. More is more, baby. Now let's take the previous example we went over, but make it a bit different. Instead of having taxable income of $58,000, let's say your annual salary is $58,000 a year. Your taxable income and your annual salary are two very different figures. If you are single and have an annual salary of $58,000, we'll make the following assumptions. You pay 6.2% of your income in Social Security tax. You pay 1.45% in Medicare tax. You pay $703 a month on healthcare costs, which, by the way, that is according to the sources that I'll list below. That's the average employer-sponsored healthcare cost for a single person in America. And then we're also gonna cross our fingers that you're contributing 10% of your income into a traditional pre-tax 401k. So in this example, to find out your adjusted gross income, we are going to subtract the 6.2% and the 1.45% of Social Security and Medicare taxes, and those two end up totaling $4,437. We're then going to subtract your healthcare costs since those are tax deductible. And annually, that ends up totaling $8,436. And since you are contributing to a pre-tax 401k, you also get to deduct that 10%. So that totals $5,800. After making those subtractions, we get to an adjusted gross income of $39,327. But wait, there's more. Now that we have our adjusted gross income, we can subtract the standard deduction. The standard deduction is just a flat dollar amount that you get to subtract from your income. For 2024, the standard deduction for single tax filers is $14,600, which means we get to subtract that from your adjusted income of $39,327, giving you a grand total taxable income of $24,727. Now you can apply the tax rates to calculate that your federal income tax owed totals $2,375. Now, is there a time when we want to avoid moving up a tax bracket? There actually are two main events that I can think of in which you will want to avoid a huge increase in taxable income for a single year: receiving a taxable inheritance and withdrawing money from a pre-tax account, such as an IRA or a 401k. Let's start with the inheritance. Most people have little to no control over the inheritance that they receive, unless it is in the form of an inherited IRA. If you are named as a beneficiary on a parent or a loved one's IRA, basically anyone as long as it's not a spouse, because those have special rules, then you will need to open what is called an inherited IRA. Now, this IRA will have to be fully depleted within 10 years of the passing of the original owner. AKA, you as the beneficiary will need to take taxable withdrawals of the entire account balance within a 10-year period of your loved one passing. Now, the timing of those withdrawals are completely up to you. You can take a full withdrawal of the entire account balance in year one, take small withdrawals each year over the 10-year period, or wait until the 10th year and take out one large withdrawal in that year. It's completely up to you. Here's the catch. If you take one large withdrawal of the entire account balance, you will most likely be paying more in total taxes than if you took out a smaller amount over time. Let's look at a quick example. You have taxable income of $50,000 and are in the 22% tax bracket. Your aunt passed away last year and names you 100% beneficiary of her traditional IRA, which is worth $200,000. If you take out the entire balance this year, your taxable income will now be $250,000, which bumps you into the 35% tax bracket. You will owe federal income tax totaling $51,820 on just the $200,000 alone. Now, if you had instead taken out $20,000 every year for 10 years, your taxable income would only be $70,000 each year. The $20K would be taxed in the 22% tax bracket, bringing your total tax owed over the 10-year period to $44,000. That's almost $8,000 less than if you took the whole thing in year one. Obviously, this example makes a lot of assumptions that the inherited account balance stays the same, tax rates stay the same, your taxable income stays the same, so on and so forth. But you get the idea. Assuming all things equal, bumping up your taxable income in a single year will result in more tax owed and should probably be avoided if possible. The same exact logic applies to withdrawing money from your 401k or pre-tax IRA. If you are retired and want to purchase a home outright instead of getting a mortgage, you may think withdrawing $400,000 from your pre-tax IRA is a smart move. After all, you won't be paying any interest to the mortgage company. However, if you take that entire amount out in 1 year, you are going to owe upwards of $110,000 in federal taxes on that money. It may make more sense to take out $200,000 in December of 1 year and another $200,000 the following January, just a month apart, but bringing your federal tax owed down to roughly $94,000. And that's just by spreading it out over a 2-year period. Better yet if you can space it out over a span of 3 to 4 years. Hopefully you now have a better idea of how the different tax rates work and you aren't scared to move up a tax bracket if you are making more money. While we are focused on covering the basics today, I will be going over more complicated tax rules over the next few weeks leading up to April. So be sure to subscribe and follow wherever you are listening right now so you don't miss those episodes. I'll have a brand new episode out for you next Monday. Till then, have an incredible and productive week. Later, rich girls.